Good morning, everyone. Welcome back to Tech Tune Up with me, your host, Paul Meeks. It looks like I'm in a Buddhist monastery here. I'm actually at my dad's place in Columbus, Ohio. Next time we have a show, I'm going to actually be in headquarters at Benzinga, Tuesday, July 9th. So I look forward to that. So obviously, we are brought here by Benzinga and also my money management firm where I run a tech portfolio for clients, and that's in Charleston, South Carolina, and we're called Harvest Portfolio Management. Check us out. So we have some interesting stuff to talk about. As always, I lead with some stock news, not just to regurgitate the news, but tell you what I'm thinking on individual securities and how they may have impact beyond in the tech sector and maybe even overall market. So I'm very interested today in Apple. Why? Apple's never been on my buy list, at least not since we've had this program. But the European Union is coming after Apple hard with a violation of the Digital Markets Act, which just went into effect. Now, the last time we met on this program, I warned about this, but now it looks like the EU is going to bring formal charges. And as you may recall, if you are snagged by the EU under the Digital Markets Act, you could face a penalty of up to 10% of not your European revenues, of your worldwide revenues. That would be an over $30 billion fine for Apple. And then it gets worse. The EU is also coming after Microsoft. Same thing goes. You can expect very aggressive attacks on all of the major tech companies, right? Apple, Microsoft, Alphabet, Amazon, and probably the other one that they have a keen eye on is TikTok, just because TikTok has such a wide audience. Of course, TikTok is controlled by the Chinese company ByteDance. So anyway, I don't like this. We're facing an onslaught of regulations in the United States, Federal Trade Commission and the Department of Justice against the very same companies. And now we have probably an even bigger threat from abroad. And these fines are not inconsequential. They are mega fines. The next, I think, is interesting. I've talked about this before, the juxtaposition between legacy media, which is in a death spiral, and video streaming, which obviously is the only way to go to absorb content these days. So I've talked about this before, but it looks like after many rounds of negotiation, Paramount is not going to be purchased. The controlling shareholder is one Sherry Redstone, and she is a weird lady and trying to extort fees that are much higher than that company's worth. Now, Paramount owns CBS, and the problem is the only reason that people log in to legacy media anymore is for the sports, right? CBS has football in the fall for the NFL on Sunday afternoons. But once we carve out sports and put it in its own video streaming service, like Disney plans to do before too long with ESPN, then there will be no reason at all to log into legacy media. So what I tell you is, because Paramount couldn't catch a bid, Paramount and Warner Brothers Discovery, which is TNT, and they lost the NBA basketball contract, these companies are toast. I don't think they survive. I think they're shorts. And as I said to you before, short or sell all these companies and just buy some Netflix. So the next thing is Google, right? Alphabet. It's kind of interesting what's going on here. I'm a fan, not necessarily because what they're doing in AI, but the rebirth in the United States, because we're not going to have a recession, in my view, in digital advertising. However, I think it is pretty cool that looks like Waymo, which is one of the groups under Alphabet's umbrella, has now decided to go from a trial with its autonomous cars in San Francisco to a full-fledged service. Anybody can order one, and we'll see what happens, because it looks to me like there is a better chance that Alphabet's Waymo will be the autonomous driving play rather than Tesla, even though Tesla has put on the calendar on August 8th, a month or so from now, their big autonomous robo-taxi event. We don't know what Elon Musk is going to say, but it's going to be something brash and bold. But anyway, I think at the end of the day, autonomous driving comes to you from Alphabet and Waymo, not from Tesla. And so if you believe that, and you believe all of Elon Musk's bluster about how big this market could be, man, that would be not just icing on the cake for Alphabet shares. That stock could go way up. And so, of course, it's on the Meeks Tech Buy list. Next, I'm going to spend more time on this in a minute. But and I tell this time and time again, favorite tech stock is Micron. They announced earnings a few days ago, and the stock got hit hard. But anyway, I'm going to defend it in a second. Next, here is Rivian. I think Rivian, which is an EV maker, is a good short candidate, because Rivian stock went up about 50% because they got some financing and they're entering into a partnership to the tune of $5 billion with Volkswagen. I don't know if Volkswagen and Rivian will co-design a car or how Volkswagen will benefit in any way. But if Rivian did not get that $5 billion infusion, they were probably going under, regardless of how cool their cars are. In the last year, they burned $5 billion worth of cash. So this gives them a lifeline. And you do not invest in a company just because they got a lifeline if they're still bleeding cash badly. This will extend the life of Rivian for 2 to maybe 3 years, and they're probably screwed nonetheless. So I take this as an opportunity to sell Rivian if you have it long, or to short it. I think I will probably short it after I watch the price chart for a couple of weeks. As of now, every time Rivian sells a vehicle, they lose $39,000. That's just the gross profit loss. That's before you get to overall company expenses. Wow, that is a huge hole to dig out of. Tesla is coming up with their robo-taxi event on August, but in the meantime, one of their go-tos was the Cybertruck. You ever seen one of these things? Looks like a spaceship. I was on a walk in my neighborhood recently, and I walked past one that was in a driveway, and the guy didn't come out and shoot me as I walked around his car in his driveway. Man, that thing is a weird-looking thing. The problem is, even though it's only recently been introduced, the stock has already been recalled. So that's another blow to Tesla. You remember, I think that this one's a terminal short. Next is Amazon. This is kind of interesting. Amazon has been losing some share on very low-cost items by 2 Chinese vendors. One is called Temu. You may remember their Super Bowl ads. It's controlled by a publicly traded Chinese company called Pinduoduo, ticker symbol PDD. And the other one is a private company called Shein, who was supposed to have a US or at least UK IPO by now, but it looks like they're struggling to get that through the pipe. Anyway, Amazon is going to offer Chinese vendors a chance to send products to us in the States directly from China, but you're not going to get them in prime delivery, Amazon 1 or 2 day shipping. The shipping is going to be about 9 to 11 days. I kind of think this is a nothing burger. I don't think they're going to be able to, with a 9 to 11 day shipping delay, take much share from Temu and Shein. In the meantime, because mighty Amazon at least announced a threat, even though I think it's a nothing burger, these 2 Chinese companies, or at least publicly traded, Temu went down. So I actually think Pinduoduo, the Chinese company, might be a better buy here. though I'm doing some more work on it. In the meantime, do not think that this is going to be any kind of catalyst on the upside for Amazon. I like Amazon for other reasons, particularly Amazon Web Services. This is going to be very expensive and probably just a loss leader for Amazon. So they stop losing e-commerce share to these two Chinese firms. Next, OpenAI. This is kind of interesting. OpenAI continues to do data licensing deals with everybody and their brother. Like, for example, you may recall that they did a deal that was announced at Apple's Software Developers Conference in the beginning of June. At the end of the day, who controls the AI turf? Is it going to be Apple, who puts OpenAI on their phone? Or is it going to be OpenAI who controls the data? Usually it's the dudes in technology that control the data. But this is kind of interesting. One of the co-founders of OpenAI, a guy by the name of Zuckerberg, left kind of in a huff from OpenAI, but is starting a competitive firm. And this might be legit because, remember, he was the technology brains behind OpenAI. He was the lead technologist, the lead R&D guy. It's kind of cool. We'll see what happens. In the meantime, it looks like it's OpenAI's game. And because Microsoft owns 49% of OpenAI, Microsoft is in the driver's seat, at least among the big tech companies. And here's another threat, Anthropic. Anthropic is another OpenAI-like startup, but it's legit because whereas OpenAI is funded by Microsoft, Anthropic has big funding from both Alphabet and even more so Amazon. So they claim that their Claude 3.5 rendition of Gen AI software is even better than OpenAI's latest division, which is 4.0. So we'll see, but it's nice to see some competition enter the space because OpenAI, early lead, you got to give them credit for that. Too deep, too powerful, and I think could be problematic over time. So what I promised, and the next thing I want to do is take a deep dive into Micron. So here's the backstory. As you know, the stock has always been, and I highlight it every time I talk to you guys, my top pick. And they announced earnings a couple of days ago. And before they announced earnings, the stock was up 65% year to date. So I and Benzinga have been absolutely right on this one. But this is kind of interesting. They took a big dump when they announced their report. Yesterday, the stock was down 7%. Today, it's caught a little bit of a bid. But here is why I'm sticking with Micron. So let's go to reasons why the street might have been disappointed to knock it down 7%. I think the expectations on the street just got too high, right? Because what they did is they announced a quarter ended May that was much higher for revenue and earnings per share than the street was expecting. So that was cool. And then they gave guidance for the current quarter, which ends August 31. And their earnings per share forecast of over $1 was much higher than the street. That was a nice welcome surprise, but I was expecting it. But the revenue guidance that they gave was only in line with the street. And of course, Wall Street hungers for more and more and more, particularly with the stock up over 60% year to date. And so I think what has happened is expectations got too high for that revenue guide. I think the company is being conservative with that revenue guide. The key thing with this stock is, I've covered it since the 1980s, is it goes where its gross margin percentage and gross margin dollars go. And in the most recent quarter, their gross margin was 28%, up from 20% in the quarter prior. And they're guiding to gross margin going from 28% sequentially to probably 35% next quarter. So the gross margin is going up. And that is the key thing. And I think the other thing that spooked some investors were they gave their capital expenditure plans. Capital expenditures is what they spend on equipment to make chips. This year, they're going to spend about 8 billion bucks on set equipment. Next year, it's going to go to 13 to 14. Now, it's going to 13 to 14 because they're building new facilities in Idaho and New York. And these are greenfield facilities. We call them fabs in the semiconductor industry. And these are very sophisticated builds. And so what happens is these are not plant additions. These are greenfield, brand new from scratch fabs. And one of the reasons they had to do this is they got money from the 2022 CHIPS Act. And so if you don't spend your CHIPS Act money, you're going to lose it. It's use it or lose it. And it was to the tune of $6 billion for them. And so they are building 2 new fabs, super tough, super long projects from scratch, but they're going to have to start building next year. So people said, oh my God, it's a commodity semiconductor company. If they build too much capacity, then there's going to be too much supply in the industry. And if there's too much supply in the industry, prices will cave. I actually think that the demand is so voracious for their AI chips, which are called HBM chips, high bandwidth memory, that I think they're doing the right thing. And I think even with the explosion in their capital expenditures from 8 billion this year to over 13 billion next year, that the demand is there, driven by AI infrastructure builds and particularly high bandwidth memory. And the nice thing about high bandwidth memory for Micron is it comes with a higher gross margin, more profitable than their regular DRAM chips, dynamic random access memory. And the DRAM chips have a higher gross margin than the company's blended average. So these will be nicely accretive to profitability. And as long as gross margin keeps on rising, this stock will, after this respite, rise again. So here's what I'm doing with Micron. Of course, I owned a ton of it, right? I've been early on the stock. Stock has doubled in the last year. My clients have made a lot of dough on it, me too. But I think what happens is I want to see the stock stabilize here, and it looks like it's stabilizing today. I thought it may drop down to its 50-day moving average support of about 126. Maybe we won't get that low. But when the stock stabilizes, I'm buying it because I think the estimates on the street for revenue and earnings per share in the out years are way too low. And I see this $130 stock, and I've said it many times before, it's going to 200. It's going to go to 200 at the peak of the next cycle, which I would say not in the next year, but probably in 2 years. So I've touted the stock. I told you what happened last week, why it happened, and why I'm still defending it. But now let's go to my tech buy list. Here you go as usual. I'm totally transparent. I'm telling you exactly what I'm trading in my own book. So here's my tech picks. In green, these are fresh money buys. In yellow, they're in the bullpen, waiting to get into the lineup. And I'll just go through some of my changes of opinion, not regurgitate the list. And also, as usual, I might have a couple of ideas that are either fresh money buys today, or I'm starting to do the work. And I think we're going to get a good result, and I'll add them to the list. So one of the things you'll see here is Meta, right? Meta's been huge for me and all my clients. Though Meta, I think, is getting a little ahead of itself here. No deterioration in fundamentals. I'm very bullish on Meta, but I'm not so bullish on the valuation. And I think in the near term, we probably have price capped here with the valuation. I think there's actually more room for further price gains in some of the favored Meeks, Mag 7 stocks or Mag 7 derivatives. I feel the same way as you go through my list here with Arista Networks, another huge stock for us. But in the meantime, getting a little ahead of itself in valuation. So Meta and Arista Networks go from the starting lineup to the bullpen. I'm still holding them, but I'm not buying them with new clients' cash. Just think they're a little expensive. Again, no comment at all on their change in fundamentals. The other two I'm thinking about is, I have this AI infrastructure theme. And on the semiconductor side, I have NVIDIA and Micron and probably Broadcom, ticker symbol AVGO. You see here on the list. I would say right now my favorite semiconductor stock among all these AI infrastructure chip company plays is probably Broadcom, AVGO. But then I complement that with the companies in which the chips go into their servers. These are AI server companies. And there I have Dell. There I have Supermicro. And there I'm adding to at least keep an eye on for potential inclusion in the lineup down the road is Hewlett-Packard. Now, Hewlett-Packard, since it spun out a couple of years ago, has two companies. The one I want is the server company, and that's ticker symbol HPE. Do not buy the PC company, ticker symbol HPQ. So anyway, I'm sniffing around. I think it probably should be added to my AI server club with Dell and Supermicro, but to be determined, probably get there, still working on it. The other company, which I think is interesting, is First Solar. You see down here, also kind of sniffing around that one. You know that I don't like these EV companies and these environmental plays, right? Clean energy plays. At least I don't typically do, right? Because they talk about saving the world, but usually their business models suck. However, First Solar is pretty interesting because they make gobs of money. So this is a company that is industrial grade solar power utility, and it should benefit from the clean to move energy, if not, or move to clean energy. If not, they're going to benefit just from the voracious demand for energy to fund or fuel these AI data centers. So anyway, here's what I'm looking for. I'm looking for First Solar to find some stability here at its 50-day moving average. That's one technical check. And then I'll probably wait until they report their earnings, which will be probably the second or third week of next month, to kind of confirm my thesis. Because the stock has come down recently, I think it's an interesting play because it is a few of those environmental companies that are profitable. But yeah, I got a technical check, 50-day moving average support, fundamental check, of which I'll get a check in with their quarter in just 2 to 3 weeks' time. But anyway, I thought it was cool enough to warn you about Meta and Arista Networks, and put on your radar for potential inclusion in your portfolios, Hewlett-Packard Enterprises, HPE, and First Solar, FSLR. So to wind up, let's take a look at a couple of tech trends. Here's some things that I'm interested in. Remember, you got to watch interest rates if you're a tech analyst, if you like to or not. 80% of the game is rates. Stocks go up, particularly in my sector, when rates go down. We're all chomping at the bit for the Federal Reserve Board, our central bank, to start lowering rates either later this year or definitely next year. So this morning, we got some pretty encouraging inflation news. And once inflation looks like it's been tamed, then we can get to those rate cuts. So today, the Federal Reserve Board's preferred inflation gauge was reported for the month of May. It's called the Core PCE. PCE stands for Personal Consumption Expenditures. It showed that core, which strips out the volatile food and energy, came down to an annualized rate of 2.6%. So right now, the Fed's key inflation indicator is running at 2.6% per annum, and the Fed will be very comfortable lowering rates once we get that down to about 2% flat. So anyway, we're making some progress. Stocks up a little bit today on, let's call it a benign inflation report, but we need to see further progress from 2.6 per year down to 2.0 to say the Fed has squashed inflation and we can start to lower rates, which will continue to keep this tech bull market alive. Right now, the risk-free rate, which is the yield today on the 10-year Treasury note, it's about 4.3%, but it's heading down and it's heading in the right direction. I've told you before that I'm kind of freaked out that too many investors are taking AI as a big catalyst for their companies. I think for most companies, you have heard me say this before, AI will be a feature. AI will be a feature on your iPhone. AI will be a feature on your laptop. And if it's a feature and not a standalone product that generates revenue and cash flow, then I don't think you should be driving up these stocks on their purported AI greatness. We know that the AI infrastructure builders, the server companies and the semiconductor companies that are building these large language models, they're legit. They're legit. They're seeing huge gains from AI right now. I just worry about these companies, typically hardware companies, that claim AI is going to drive huge upgrade cycles in their hardware when, I don't know, if AI is a feature and everybody has it and it becomes totally not distinctive, then I don't know, it's not a good deal. So I do not believe in the AI follow-on. I'm only investing in the first half of the game, and then I expect to get off and not play in the second half of the game. First half of the game is AI infrastructure build. The second half of the game is all these cool products in AI. Believe it when I see it. So one of the things I need to get more convinced that there is an afterlife for AI is what we call generative AI use cases, where major companies are saying that they're using AI, it's bringing all of these wonderful savings, or it's driving revenue, or better, even both. And I guess there have been a couple of what I think major use cases, maybe convincing factors announced in this past week. Goldman Sachs, the big investment bank, has talked about using a Gen AI tool all across its organization. Now, Goldman Sachs is a big tech spender, marquee investment bank in New York. Okay, maybe that ends up being a legitimate use case. Also, our buddies at Amazon. Of course, Amazon are front and center in this, particularly with their Amazon Web Services, in which they outsource data center capacity, and also with their investment in Anthropic with cloud, which is a competitor OpenAI. They are saying that they are using generative AI across the company's internal finance function. Okay, that might be cool, right? Amazon, everybody watches them. Everybody agrees they're a tightly managed company. Let's see what happens. But anyway, maybe these two, one from financial services, the other one from tech, end up being legit confidence for me use cases for generative AI. But at the end of the day, who wins? You know who wins? Are the dudes that control the data. So when I saw this announcement a couple of weeks ago at Apple's Software Developers Conference, that they're going to put OpenAI on their iPhone, at the end of the day, I think it becomes just a feature for Apple. Maybe it gets you to upgrade to the iPhone 15 Pro. Maybe it doesn't. But who is going to make the money? The money is going to be made by the guys that control the data. And the large language model, or the data, is OpenAI's intellectual property. So in any kind of tech move over all these decades I've covered the sector, the guys that win are the guys that control the data. And in the meantime, we're spending a lot of money. The investments from venture capitalists were up fivefold in 23 from 22 in AI derivative plays. But again, I think a bunch of them are going bust, because if it's AI as a feature, who gives a shit? If it's AI as a product or a product platform, which is going to be controlled by the dudes that control the data, then maybe we got something. all to be determined. But in the meantime, I just stick with the infrastructure plays, and I'm going to wait to see if these AI products are legit. Anyway, I think that's a huge way. And I'm kind of contrarian in my view here, because most people believe that they're already placing their bets on the second half of this game. And I think the first half of this game might be all I want to play. So you guys, I look forward to seeing you on Tuesday, July 9th, where I'm going to be broadcasting this show from the Detroit, Michigan headquarters of Benzinga. I'm really pumped for that. But anyway, in the meantime, stay tuned. See you next time.